Bad news is good news. That is a phrase that emerged for the first time ever, I believe, during COVID when the Fed was engaging in record easing policy, tremendously easing policy. And it just so happens that a lot of the prices we're experiencing now are very similar to the prices we experienced in that environment. But I make the argument that the bad news is good news experience has now ended. And that is no longer the case. And we are now entering the least desirable of the four possible combinations of inflation and growth, and that being lower inflation and lower growth. However, I'm not even sure if our inflation battle is over yet. Why do I say that? Well, I say that for two reasons. The first being simply look at the data. The second, I'll mix in the way the Bank of Canada addressed the data just today after an unexpected hike, after a pause, and our Fed has said similarly. A lot of people want to point to headline CPI, but Bank of Canada said today, headline CPI, it's showing a massive decline in energy and the base effects. If you look at month-on-month numbers, you're not seeing any progress there. If you're looking at core numbers, you're not seeing any progress there. As a matter of fact, you're seeing momentum in core progress slow and arguably reverse. It bottomed many months ago. I believe it bottomed something like November of last year, progress in core inflation month on month. So despite that, we've given interest rates some lag time. We've given interest rates some higher levels. And we're really stalling out on this progress. That's why I think you're seeing the IMF today say the Fed has to stay on its tightening policy and the rest of the central banks be very hawkish. And we're really banking on a lot here, expecting Fed pivots at every meeting, having expected cuts by the end of this year, and now having this yet another leg of the rally, at least did have another leg of the rally in some parts of the market. We'll get to the breadth discussion later, but anyways, this most recent leg of the rally based on what two Fed members said, and it's a real return to normal. However, the normal is not going to return. I say that because when you nail down into what has been said about the long-term future of interest rates, there have been multiple instances that what we once considered normal just a year or two ago and in the time before that is not something that's going to return. What exactly are we talking about? We're talking about the secular trend in lower interest rates. The day before SVB failed, Jerome Powell said the secular trend in lower interest rates was likely over. It had been going on since the 80s, since the last inflation battle, and he said that trend of secularly lower interest rates was likely over. Let's not forget, this was not the peak in the 10-year, the 20-year, the 30-year, or any of those rates that occurred, I believe, in October or November. This was the day before SVB failed. They went on to hike two more times after that. They went on to put out a more hawkish dot plot, which they have hinted at might actually go up at this meeting next week. And I think that is an unaccounted for, undiscussed risk that we might actually get a more hawkish dot plot, because it seems like a lot of people are expecting the same dot plot or no change in the hawkish direction, a possible pause at this next meeting, and a pause and not a skip or something like that. Anyways, that was followed up just the two speakers right before we had the two speakers who talked about and kind of solidified the potential for a pause or a skip starting with this next meeting, although both of them were very adamant about the fact that it would not signal the end of the tightening cycle. Barkin spoke before them, and he said even if there is a recession in the future, it's likely they don't bring interest rates down to zero. That is a very important thing to calculate and accept when determining the longer term interest rate. So I think, just going right back to where we were in the most stimulated economy of all time, in the most friendly monetary policy of all time, in the biggest printing of money we've seen in this country, to go from all of that to first ever money supply decline in the history of this country. If, it maybe there was something way before, but the data that goes 100 years I've seen doesn't show any. QT, we've done brief experiences with QT. Obviously there's that possibility the Federal Reserve reverses, but doesn't seem like that's going to happen. Doesn't seem like that's going to happen when they've got these massive money market balances that they're paying interest on, and they see all this money out there in the system. I don't think they're going to reverse and start printing money again anytime soon when we had all this inflation. The past times when they reversed their decline in the balance sheet, they didn't have an inflation problem to deal with. Now they do. Now they've had that problem. They're probably not going to reverse the QT for a very long time. So I think we're going to continue to see balance sheet runoff and continue to see decline in the money supply. So to think we could have all these things and just possibly beginning to feel the effects of a possible recession. The big argument for the rally, for, hating on the Bears and trying to destroy their credibility has been, we were expecting a recession last year. We didn't get it. Well, first of all, Target, I said at an earlier video, the most recent Target earnings call, I also got a notification from a photo from 1 year ago that day that said they weren't seeing no signs of a consumer slowdown. That's very different than what they were saying at the last earnings call, where they said March was weakening, April was weaker than March, and May was weaker than April. Okay, so consumer definitely is weakening now compared to last year. But last year, by May, the Fed had just stopped printing money. Like, they were printing money in March. They had just started a few slight interest rate increases and were very far from being arguably at real interest rates, real positive interest rates. They were at negative interest rates. It was still a very good thing to borrow money. So now we have rates that are arguably at the lower end of restrictive if you use the Taylor rule, but John Taylor has said need to go higher. And now you are finally at a level where there might be some restraint on the economy in a few months from when we reached that level or did something, So I don't think that's a valid argument. I think it was maybe premature for the bulls to expect a recession last year, but I don't think the argument that it's going to be completely avoided is valid simply because it hasn't occurred yet. I mean, we just got something out of Europe that said, they're in a recession, right? So you got those monetary and interest rate forces. And then you add on top of that a possible recession. I don't care what the jobless claims are. I don't care that they're slightly better than expected. I mean, or slightly more bad news than expected. Like, it doesn't matter. That is an old thing when we were expecting the Fed to just come and, give us some more stimmies. That's what that was about. That's not happening anymore. That's gone. So we got to get to grips with the fact that bad news actually might be bad news. The fact that manufacturing numbers are so weak, that might not be a good thing. People losing their jobs might not be a good thing, especially when you consider the fact that credit card delinquencies are starting to normalize. You're starting to see young adults fall behind on auto payments. You're starting to see the, fearful things start to pick up, and we haven't seen the layoffs yet. So to think that, losing more jobs is a good thing, it's just like bonkers. And it's not even like we're losing that many jobs yet. This ain't nothing. This is still well below the 10-year average for weekly jobless claims. And the continuing claims was cooler than expected. So I just think today's rally, super narrow. RSP spent most of the day red, still, came in way less than the equal weighted indices or the market cap weighted indices. You look at what happened yesterday, it was like a straight annihilation in the biggest companies. Finally, they had a little bit of that, excluding Tesla. And you had a rally in the banks. And I believe like the banks were down pre-market either yesterday or the day before and then finished up a lot. Today you had the banks slightly up, or the regional banks we're talking about here. Regional banks slightly flat in the pre-market, and then they dump at the open. It's like it's not healthy behavior. This is not, fundamental price discovery. This is chasing, this is fear of missing out, this is looking for a swing. This is non, the short-term emotional things, the jobless claims, the better than expected. That is very easy to, do and, make a thing, make a move on and have the market rally short-term on. The longer-term things are much easier to see if you can just, quiet all that stuff out. Much easier to play in the longer term. But I suppose, very difficult in the short term or something. I guess that's just what it is. Maybe I'm wrong here, but I think, it's not the best situation. And I think bad news is good news should probably be over. So that's today's video. We'll see what happens. Until next time, peace out.